California's housing market has always been larger than life. It's a place where coastal views and big city dreams collide with price tags that leave buyers gasping. In 2025, the market tells a new story: slowing sales, high interest rates, and homeowners squeezed by rising insurance costs. But not every city is suffering equally. Some still show surprising resilience, while others are slipping fast into dangerous territory. For buyers, the challenge is knowing which markets still hold some stability, and which ones could drain your finances before you've even settled in. In this video, we're counting down the 12 worst cities to buy a home in California this year. We'll start with markets that appear strong on the surface but hide serious risks beneath, and we'll build all the way to the city that experts say is the single riskiest bet in 2025. Number 12, San Francisco. San Francisco has always been a paradox in the housing market. It's a city with world-famous views, a booming tech sector, and a culture that attracts people from around the globe. But it's also a market where the dream of owning a home has been out of reach for most households for decades. In 2025, the numbers show resilience. Median home prices have inched up almost 2% compared to last year, and homes are spending less than a month on the market. At a time when many California cities are cooling, that seems like a sign of strength. A major driver of this resilience is the city's job market, especially the surge in artificial intelligence and related technologies. Tech firms continue to lure high earners who can sustain million-dollar price tags, but that stability hides deeper risks. The median price remains well above $1.2 million, meaning the vast majority of local families are priced out. Even for those who can afford it, monthly mortgage payments, often exceeding $7,000 when you include insurance and taxes, stretch household budgets to the limit. Condos, which once offered a relatively affordable entry point, are now lagging. They're sitting longer on the market, with more sellers forced to cut prices or offer incentives just to move inventory. That split between single-family homes and condos highlights an important risk. Demand is concentrated at the very top of the income scale, while the broader market is softening. Another challenge is the cost of maintaining older homes. San Francisco is full of historic Victorians and Edwardians. These homes are beautiful, but they require constant upkeep. Many buyers underestimate the financial burden of retrofitting for earthquakes, updating plumbing and wiring, and paying for insurance that continues to climb due to wildfire exposure across the state and the city's own seismic risks. For investors, the question becomes, where's the upside? Prices aren't falling, but they're not soaring either. Appreciation is slowing, and rents have plateaued after years of growth. San Francisco remains one of the most expensive places to buy in America, but with limited potential for equity gains, it's become a market where owning is more about status than smart investing. That's why it ranks low on our list, not because it's crashing, but because the buy-in is massive and the payoff uncertain. Number 11, Santa Cruz. Santa Cruz is one of those places that captures the imagination. Nestled between the Pacific Ocean and the Redwoods, it embodies the California dream: surf culture, boardwalk amusement rides, small town vibes. It's a postcard come to life. And yet, for buyers, it's a financial minefield. The median home price here is well above $1 million, and bidding wars remain common. Homes often sell in under 2 weeks, which makes the market look red hot. But that speed has little to do with affordability and everything to do with scarcity. Local incomes are far too low to justify these prices. Service jobs, tourism, and education make up a large share of the employment base, none of which pay enough to support million-dollar mortgages. Instead, wealthier buyers from Silicon Valley and the Bay Area flood in, driving up demand and crowding out locals. This imbalance creates a fragile market. Prices are propped up by external money, not local fundamentals. If Bay Area tech demand weakens or commuting patterns change, Santa Cruz could face sharper corrections. Even now, the gap between what homes cost and what locals earn is among the widest in the nation. Another major issue is insurance. Wildfire risk has made Santa Cruz County a tough sell for insurers. Premiums are rising quickly, some companies have withdrawn entirely, and homeowners are being pushed into the state's FAIR plan. That coverage is more expensive and less comprehensive, leaving many households exposed. For new buyers, it means your monthly costs could be hundreds or even thousands more than expected. The lifestyle here is undeniably appealing. Mornings can be spent hiking in the Redwoods, afternoons surfing at Steamer Lane, evenings dining downtown. But the cost of entry is astronomical and the risks are mounting. Santa Cruz looks beautiful, but behind the surfboards and sunsets is a housing market that punishes anyone without deep pockets. Number 10, Los Angeles. Los Angeles is California's largest housing market, and in many ways, it reflects the state's housing story better than anywhere else. It's glamorous, diverse, and endlessly desirable, but it's also painfully unaffordable and increasingly sluggish. The median home price sits above $900,000, and while that's slightly down, less than 1% compared to last year, it still represents one of the most expensive urban markets in the nation. What's changed is the pace of activity. Homes that once sold in just over a month now linger for nearly 2. Sellers are cutting prices or offering concessions like covering closing costs to lure buyers. Affordability is the biggest obstacle. Mortgage rates above 7% push monthly payments on a median-priced home well beyond $5,000, even before factoring in insurance and property taxes. For households earning 6 figures, that's still a heavy lift. Add in soaring insurance costs and hillside neighborhoods exposed to wildfire risk, and it becomes nearly impossible for middle-class families to buy. Los Angeles also faces demographic headwinds. Population growth has slowed dramatically, and in some years, the city has actually lost residents. Many younger families are leaving for more affordable states like Texas or Arizona. That outmigration erodes the buyer pool, leaving demand concentrated among investors, foreign buyers, and high earners. On top of that, rental growth has stagnated. Investors who once snapped up properties for short-term rentals face stricter regulations, while long-term rent caps limit upside. For individual buyers, this means limited opportunity for appreciation or cash flow, and yet the risks aren't just financial. Los Angeles is a city where commuting times, air quality, and infrastructure challenges make homeownership even harder. Add in the fact that natural disasters, wildfires, earthquakes are a constant background risk, and the equation looks even worse. In 2025, Los Angeles isn't collapsing, but it's grinding to a halt. Prices aren't falling sharply, but the affordability ceiling has been hit, and the fundamentals don't justify the costs. For buyers, that makes Los Angeles one of the toughest places in California to invest in real estate. Number 9. Riverside City. Riverside sits at the heart of the Inland Empire, a region that saw explosive growth during the pandemic. Families priced out of Los Angeles and Orange County flocked here for bigger homes and cheaper prices, fueling bidding wars and record sales. But by 2025, the tide has turned. Median home prices in Riverside have slipped more than 2% year over year, and homes now sit on the market for nearly 2 months compared to just a few weeks during the boom. Inventory has risen steadily, leaving sellers competing for fewer buyers. On the surface, these declines look small, but they highlight the vulnerability of a market that grew too fast, too quickly. Riverside's strength is affordability relative to coastal California. The median price is still hundreds of thousands lower than in Los Angeles, making it attractive for families. But the trade-offs are clear. Commutes into LA or Orange County can stretch past 2 hours, especially with traffic. Gas prices remain among the highest in the country, eating into whatever savings buyers thought they'd found on housing. Insurance and wildfire risks also weigh heavily. Riverside sits in California's high-risk fire zones, and many neighborhoods face rising premiums or dwindling coverage options. For buyers, that adds unpredictability to long-term costs. In 2025, Riverside is a market in transition. It's not collapsing, but it's cooling fast, and anyone buying here should be prepared for slower appreciation and higher risks than just a few years ago. Number 8. Sacramento City. Sacramento has long been called the last affordable California city, but that reputation is quickly eroding. During the pandemic, Bay Area workers migrated east, driving home prices up by more than 40% in just a few years. Now the correction has arrived. Home prices in Sacramento are down nearly 3% year over year, and properties that once flew off the market in 17 days now linger for almost a month. Sellers are adjusting expectations, and buyers are taking their time. The slowdown isn't catastrophic, but it signals that Sacramento's pandemic boom is firmly over. Affordability is the main concern. With a median home price above $500,000, Sacramento is no longer the budget-friendly alternative it once was. The city's household incomes haven't kept pace, leaving locals stretched thin. Many of the buyers who drove the boom were remote workers from San Francisco, but as return-to-office policies tighten, that demand has slowed dramatically. On top of that, Sacramento faces environmental risks that weigh on the market. The region is prone to both flooding and wildfire, making insurance a growing challenge. premiums are rising, and some insurers have scaled back coverage in high-risk areas. For many families, that pushes the true cost of ownership well above what the list price suggests. Another complication is infrastructure. Sacramento continues to grow, but transportation, water systems, and healthcare capacity are strained, creating bottlenecks that frustrate residents and limit long-term livability. These pressures, combined with slowing in migration, mean the city may not have the same growth engine it did just a few years ago. Sacramento still has strengths. It's the state capital, home to stable government jobs, and offers more space than the Bay Area. But in 2025, the market is fragile, and buyers should be cautious. Number 7, San Diego. San Diego has long been one of California's most desirable housing markets, famous for its perfect weather, beautiful coastline, and strong economy. But in 2025, that desirability comes with serious drawbacks for buyers. Median home prices in the city have fallen about 6% year over year, while homes now sit on the market for an average of 32 days, almost double the pace from last year. The slowdown is stark, particularly for a city once considered nearly immune to downturns. Part of the problem is affordability. With median prices still hovering near $900,000, higher mortgage rates have locked out much of the middle class. Monthly payments often exceed $5,000, and even well-paid professionals struggle to qualify. Investors have also pulled back, leaving fewer buyers in the pool and weakening demand that once seemed unstoppable. San Diego's rental market, once a safe haven for investors, is cooling too. Rents have leveled off, and stricter regulations on short-term rentals are cutting into profitability. For buyers hoping to offset costs with rental income, the numbers no longer add up, making real estate less appealing as an investment strategy. Environmental risks deepen the challenge. Coastal neighborhoods face rising sea levels, while inland areas struggle with wildfire exposure. On top of that, insurance premiums are soaring, adding hidden costs that further strain household budgets. Even homeowners with solid incomes are realizing that true affordability here is slipping further away. San Diego's lifestyle remains unmatched. Sunshine, beaches, cultural diversity, and a booming tourism industry. But in 2025, the financial realities behind the postcard image make it one of the riskiest big city markets in California to enter. Number 6, Palm Springs. Palm Springs has always been a market of extremes. Once a glamorous escape for Hollywood stars, it has transformed into a hub for retirees, vacation homeowners, and Airbnb investors. But the cracks are showing in 2025. Surprisingly, the city's median home price is up more than 15% year over year. At first glance, that looks like strength, but the details tell a different story. Homes here now take more than 90 days to sell, triple the time it took during the pandemic boom. The market is deeply uneven, with some neighborhoods seeing bidding wars and others languishing with price cuts. Palm Springs is highly dependent on second home buyers and short-term rentals. That makes it especially sensitive to economic swings. As interest rates remain high and rental regulations tighten, many investors are pulling back. The city has already imposed stricter caps on vacation rentals, reducing potential income for new buyers. Climate is another challenge. Summers regularly exceed 110 degrees, straining both infrastructure and residents. Insurance costs are rising across the Coachella Valley, and water scarcity adds another layer of concern. For long-term buyers, these risks weigh heavily on future value. Palm Springs still shines as a lifestyle market, with golf courses, pools, and desert sunsets. But in 2025, buying here is less about financial sense and more about personal luxury, an investment with more downside than upside. Number 5, Stockton. Stockton has long carried the reputation of being one of California's most volatile housing markets. It was one of the hardest hit cities during the 2008 crash, and in 2025, warning signs are flashing again. Median home prices in Stockton have fallen nearly 7% year over year, among the steepest declines for mid-sized California cities. In the city center, the picture is even worse. Some neighborhoods have seen values sink more than 30% compared to last year. Homes that once sparked bidding wars now sit unsold for weeks, and inventory is climbing as sellers chase a shrinking pool of buyers. The problem is a mix of affordability and economic fragility. Stockton attracts families priced out of the Bay Area, but The trade-off is long commutes and a limited job base. With higher mortgage rates, those commuting costs and modest local wages are colliding, leaving many households financially stretched. Families who stretched to buy during the pandemic are now squeezed not only by payments, but also by rising insurance, utilities, and general living costs. The rental market, once a strong draw for investors, is also cooling. Statewide rent controls cap upside, and slowing job growth reduces rental demand. For buyers, Stockton's history of sharp boom and bust cycles looms large, and in 2025, the risks outweigh the bargains. It may look cheap compared to Bay Area markets, but the reality is a fragile city highly exposed to economic shocks. Number 4. Burbank has always been tied to Hollywood, with major studios like Warner Brothers and Disney anchoring the city. Housing demand was fueled by entertainment industry jobs and investors eager to be near Los Angeles' creative hub. But the picture in 2025 is much darker. Median home prices in Burbank have dropped more than 12% year over year, one of the steepest declines in Southern California. Homes that once sold quickly now linger, and sellers are making bigger concessions to attract offers. The slowdown in film and television production, partly from strikes and partly from industry restructuring, has weakened the local economy, leaving many households less able to afford Burbank's traditionally high costs. Even with the declines, homes here still sell for close to $1 million, which means affordability remains out of reach for most families. Mortgage payments are sky high, and insurance premiums are climbing, especially in hillside areas exposed to wildfire risk. Investors who once relied on short-term rentals in Burbank have also faced stricter local regulations, reducing potential returns. Adding to the challenge is the city's limited land supply. With little room for new construction, Burbank depends heavily on its existing housing stock, which keeps competition fierce even in a downturn. This imbalance between inventory and affordability makes it difficult for new buyers to find long-term value, especially as wages in the entertainment sector remain volatile. For buyers, the danger is clear. Burbank's appeal is still tied to an industry facing uncertainty, and with double-digit price declines already underway, further softening is possible. It's a market caught between high costs and falling demand, making it one of the riskiest bets in California today. Number 3. Oakland. Oakland has always been in San Francisco's shadow, offering more affordable housing just across the Bay Bridge. For years, that made it one of the hottest markets in Northern California. But in 2025, Oakland is suffering some of the sharpest declines in the state. Median home prices are down more than 13% year over year, and the market has shifted firmly in favor of buyers. Sellers are cutting prices, offering incentives, and in some cases pulling listings altogether. Homes that once sold in days are now sitting for months as buyers weigh their options in a cooling Bay Area market. The city's challenges go beyond real estate. Oakland faces rising concerns about crime, public safety, and declining tax revenue as some businesses and families relocate. Combined with high interest rates and soaring insurance costs, these issues are pushing more buyers to the sidelines. Investors who once saw Oakland as a spillover market from San Francisco are now far less confident. Adding to the strain is the uneven recovery across neighborhoods. While a few areas near transit hubs or with strong community investment remain stable, large swaths of the city are struggling with vacancies and slower demand. That patchwork performance makes Oakland unpredictable, discouraging cautious buyers who don't want to gamble on which areas will rebound. The result is a market in retreat. Prices may look more affordable compared to San Francisco, but with double-digit declines and broader city challenges, Oakland is a risky place to park money in 2025. What was once a promising alternative now looks like a market in distress. Number 2. Santa Barbara. Santa Barbara has long been a symbol of luxury on California's central coast, with Mediterranean-style homes, ocean views, and a climate that feels like paradise. It has attracted wealthy buyers from around the world, but even paradise has problems. In 2025, the Santa Barbara market is showing volatility unlike almost anywhere else in the state. City-level data shows home prices down more than 23% year over year, though the broader county is still up around 7%. That kind of split highlights just how unstable the market has become. Some segments, particularly ultra-luxury, are struggling with slower sales, while others remain buoyed by wealthy buyers who can pay in cash. Insurance is a major challenge here. Santa Barbara sits in wildfire-prone terrain, and premiums are rising sharply. Some insurers have stopped writing new policies altogether, forcing homeowners into the state's FAIR plan, which is both costly and limited. Combined with already high mortgage payments, these insurance hurdles push true monthly costs to eye-watering levels. Adding to the strain is a widening gap between local incomes and home values. Teachers, healthcare workers, and service employees who keep the city running are increasingly priced out, while much of the market caters to second home buyers and investors. That imbalance leaves Santa Barbara dependent on a narrow slice of buyers, making downturns hit harder and recoveries slower. The lifestyle is stunning: wine country, beaches, and a small-town atmosphere that feels far removed from Los Angeles. But that beauty comes at a steep price, and the risks are growing. In 2025, Santa Barbara is less a safe haven and more a volatile luxury market where buyers need to tread carefully. Number 1. Mendocino. Mendocino County is often romanticized as one of California's last untouched frontiers. Stretching along the Northern California coastline, it's known for its towering redwoods, rugged cliffs, vineyards, and quiet coastal towns like Fort Bragg and Mendocino Village. But behind the beauty lies one of the state's most troubled housing markets in 2025. Home prices here have fallen more than 15% compared to last year, and the market is sluggish. Properties that once sold within a few weeks now sit for nearly 3 months. Inventory is climbing as more owners try to sell, yet buyers are scarce. The result is a county sliding into a buyer's market, but without the buyers to stabilize it. Part of the problem is economic. Mendocino is heavily rural, with limited employment opportunities. The economy relies on agriculture, tourism, and small-scale industries. Wages are modest, and population growth is flat to negative as younger residents move to urban centers for better opportunities. With fewer stable, high-paying jobs, sustaining demand at previous price levels has proven impossible. Insurance is another major drag. Much of the county is categorized as high wildfire risk, and insurers have responded by raising premiums or pulling out altogether. Families who once dreamed of owning a cabin in the redwoods now face annual insurance bills that rival a second mortgage. Many have turned to California's FAIR plan, which offers only minimal coverage at high costs. For buyers, that means home ownership here carries financial uncertainty from the start. Infrastructure also presents challenges. Rural roads, limited healthcare access, and unreliable internet service make long-term living difficult, especially for those hoping to work remotely. Add in California's broader affordability crisis and rising cost of essentials, and Mendocino becomes a place where the scenery is priceless, but the housing market is perilous. On paper, the drop in prices might make Mendocino look like a bargain, but bargains in high-risk areas rarely stay that way. Liquidity is low, resale potential is weak, and the true cost of ownership, from insurance to maintenance, are high. For buyers in 2025, Mendocino represents the riskiest market in California, where the promise of coastal charm comes with more risk than reward. And there you have it, 12 California cities where buying a home in 2025 is more gamble than investment. Some markets are simply expensive, others unstable, and a few like Mendocino combine both. Thanks for watching, and stay tuned for more housing insights.